Elliott Gue here, Chief Strategist for Energy and Income Advisor. A little while ago, I sent you a link to an online presentation concerning global energy markets and what I'm convinced will be a major move higher in oil prices, related stocks, and other basic commodities over the next 12 to 18 months. I also promised I'd unveil through a series of presentations and reports exactly why my research confirms that $100 a barrel oil is almost inevitable due to some fateful decisions made over the past few years by some of the world's largest energy companies. And depending on decisions made by these same companies and governments over the next year or two, oil prices could actually head a lot higher than $100 a barrel. We may even see Brent oil prices break above their historic summer 2008 highs of around $150 a barrel. Listen, I know these calls may sound pretty aggressive, maybe even downright outrageous. However, just remember, some pundits scoffed at me just 4 years ago when I predicted the big sell-off in oil prices below $30 a barrel. This was when oil was still over $100 a barrel. And I predicted the collapse of many popular energy stocks like Seadrill, Chesapeake Energy, and so many others that have since collapsed. 4 years ago, a bear market in energy sounded outrageous, just as outrageous as $100 oil prices may sound today, and went against the popular narrative for the sector in the media. Yet I was just following the conclusions of my research and the historic precedent of past commodity cycles to make that call. And today, I'm once again simply following the same research to its logical conclusion. I'm not exaggerating when I tell you that if you get this stage of the commodity cycle right, you could make some serious cash over the next couple of years. However, I also must warn you that if you ignore the inflationary cycle for commodities we're entering right now, the consequences for your portfolio could be devastating. So today, I want to get started with this crucial trend. I call it going extinct, the world's last giants. This on your screen is a basic map of Africa, and I've circled the country of Angola in red here in the southwestern part of the continent. You may have heard that Angola was the site of a particularly long and bloody civil war that actually lasted from 1975 until 2002 and tragically resulted in more than 500,000 civilian deaths and over 1 million people permanently displaced from the country. However, Angola today, a country of around 29 million people, is also home to some immense mineral and natural resource wealth, including some truly giant oil fields. Much of Angola's oil wealth is located offshore, here in a series of numbered oil concession blocks located in what are known as the Kwanza, Congo, and Namibia sedimentary basins. Angolan oil production grew steadily from the early 1980s through the early 2000s, despite the ongoing civil war at that time. However, production really boomed as the war came to an end in 2002, jumping from less than 1 million barrels a day to more than 1.8 million barrels a day. The reason? Angola offshore block number 17, also widely known as the, quote, golden block, was discovered back in the late 1990s, and it was brought on stream between 2001 and 2014. It's actually operated by French oil supermajor Total, and has produced as much as 700,000 barrels per day. Then there was Block 15, operated by US supermajor ExxonMobil, that came on stream shortly thereafter. Today, it produces more than 150,000 barrels a day. And BP, the company you probably know as British Petroleum, is the operator on blocks 18 and 31, which came online between 2004 and late 2012 and produced at maximum rates of 250,000 and 150,000 barrels a day, respectively. Listen, here's what's really crucial. Angola's oil boom between 2002 and 2015 or so was a direct result of literally tens of billions of dollars of investment in very expensive and technically complex offshore and deep water oil exploration and development projects. While Angola's national oil company has a stake in these deals, in fact, that's actually required by Angolan law, most of the capital, most of the technology and expertise comes from American and large European supermajor oil companies. Well, that brings me to this very troubling trend. This is a chart showing monthly oil production data for Angola. As you can see, in April, the country only produced around 1.5 million barrels a day of crude oil, close to its lowest production rate in about 11 years. And here's what really has me worried. You see these prior spikes lower in Angolan oil production that I'm highlighting on the chart on your screen? These were the direct result of temporary maintenance work on wells and oil-related infrastructure such as storage and pipelines. Now, the current decline is different. The current decline in Angolan oil production is not the result of maintenance work. And in fact, the nation's oil production is expected to continue falling in May and June. Now, this is a chart of Angolan crude oil loadings over the past 10 years. Now, loadings is a term that means the amount of oil that's scheduled to be loaded onto tanker ships for export. And the great thing about this data series is that since tanker loadings are scheduled weeks in advance, it gives us a peek into the future. It gives us an idea of what future Angolan oil production and exports will look like over the next couple of months. So quite frankly, I find this data particularly worrying. You see, Angolan tanker loadings in June are scheduled to be a little under 1.38 million barrels per day. Now that's the lowest level in more than a decade. And June is not normally a seasonally weak month for Angolan crude oil exports. Since its beginning of summer driving season in countries like the US, Angolan exports are typically strong and in high demand in the summer months. However, this year, Angola will export less than 1.4 million barrels of oil per day, down 285,000 barrels a day compared to the same month just 1 year ago. That's June 2017. And this is also a more than decade low in Angolan crude oil tanker loadings. Now listen, here's the crucial thing. Unlike Nigeria, Angolan oil production isn't falling because of domestic issues or attacks on key pipeline and energy-related infrastructure. And unlike Libya, it's not in the middle of a civil war. The war ended back in 2002. And while Angola is a member of OPEC, the country isn't intentionally keeping down its crude oil exports and production to meet the quota. As you can see from the table on your screen, Angola agreed to cut its oil production by 80,000 barrels a day from a September 2016 reference month as part of that late 2016 OPEC and Russia production agreement. However, in the most recent month, Angola actually had cut production by 230,000 barrels a day compared to its reference month. That's nearly 3 times larger cut than Angola agreed to back in November of 2016. The reason Angola's production is falling is simple geology. You see, all conventional oil fields in the world are subject to something known as a decline curve. What this means is that as the fields mature and oil and gas are produced from the field, underground pressures drop and the rate of production, and that's measured typically in barrels per day, falls. That doesn't mean the field is running out of oil. Actually, oil fields usually see peak production even long before 20% of the oil actually in the field is produced. But on a global basis, the base decline rate is estimated at 5% to 7% per year. That means if no new fields were brought online in a given year, world oil production would fall in the order of 5 to 7% because those existing older fields are maturing and seeing declining production. In effect, you could say that oil producers are running on a treadmill, right? In order for global oil production to grow, producers must first offset this base decline rate with new production and new projects. Now let's get back to the situation in Angola. Because Angola's oil fields are mainly located in deep water and have high underground geologic pressure, they are very prolific producers, but they also have a faster decline rate than the global average. In fact, Angola's giant fields have a much faster decline rate, roughly 2 to 3 times faster than the global average, at roughly 13 to 18% annualized. So you could say that Angolan oil producers, like Total, ExxonMobil, and BP, are running on a treadmill that's set at a much faster speed than the rest of the world. So here's what's happening in Angola. There haven't been any significant new oil production projects brought online since about 2014, and fields that were brought on in the 2002 to 2012 range are now mature and seeing production decline at that 13 to 18% annualized pace. With no new projects to offset that high base decline rate, Angolan oil production is plummeting. Listen, There is a temporary reprieve coming for Angola, starting as early as this summer. I think probably by August, maybe September. However, I must warn you, the emphasis here is on the word temporary. It's called Kaombo, and it's an ultra-deepwater project led by Total of France in Angola's offshore block number 32. It's a truly massive project involving 6 major offshore oil fields, 60 subsea wells located in water up to around a mile deep, 186 miles of subsea pipelines, and 1.7 million barrels or more of oil storage capacity. The field was originally scheduled to enter production in 2017, but it's been delayed for a startup this summer. Now, production is eventually expected to ramp up to as high as 230,000 barrels a day as a peak production rate. However, there are 2 very important points to note about this mega project. First, the fields Total is producing as part of this deal were discovered way back in 2005, 2006, and 2007, so roughly 10 to 13 years ago. And the total cost of the project is upwards of $16 billion. In short, it's a very expensive and complex project that has taken more than a decade to bring from field discovery to first oil production. Second, Total made its final investment decision on Kaombo back in April 2014. And that was a few months, if you remember, before the big collapse in oil prices, when crude was still trading up around $100 a barrel. So here's the problem. Look at this chart. This chart tracks capital spending, or CapEx, from 16 global integrated oil companies. That includes Exxon, Total, Shell, as well as companies like Brazil's Petrobras and other national oil companies. The total spending for these 16 super major oil companies is in blue on your chart. And the chart also includes CapEx for about 60 independent oil and gas producers, and these are mainly focused on North America, and in particular, the shale plays here in the US, like the Permian Basin of West Texas. Now, spending from these independents is depicted in orange in your chart. As you can see, overall spending for these companies, both the integrated companies and the North American producers, was just shy of $500 billion. That's $500 billion per year back in 2013 and 2014. And it fell to around half that amount, somewhere in the $230 to $260 billion a year range in 2016 and 2017. And that's a trend that's expected to continue here in 2018. In total, if we compare spending in the period from 2015 through 2017 and planned spending for this year relative to the sort of norm back in 2012, 2013, and 2014, the total shortfall in capital spending works out to $786.3 billion. Now that's a cumulative total of nearly $800 billion in CapEx cuts over just a 4-year period. I must tell you, this capital spending recession is unprecedented in duration and magnitude for the global energy industry. Here's the really important point. That $786.3 billion in missed CapEx is the money that would normally be spent to develop giant oil projects like Kaombo in Angola. Multi-year, multi-billion-dollar projects like Kaombo, and in other countries around the world, of course, are the backbone of the global energy industry, and developing new fields is the only way to offset the erosion in global production caused by that base decline rate I mentioned earlier. The only reason Kaombo was developed is that Total made its final investment decision before the big collapse in oil prices 4 years ago. As a result of plummeting oil prices over the past 4 years and the decline in capital spending I just outlined, there are a dwindling number of new mega projects like Kaombo all over the world due to come on stream over the next year or two. Because these giant projects take many years to develop and there is no way to reverse this effect, capital spending decisions that have already been made will continue to impact global production for the next 3 to 5 years, and that's regardless of what global producers decide to spend over the next 2 or 3 years. You could say that Kaombo is one of the last giant projects of its kind that was authorized before the big bear market in oil prices. And even with Kaombo's added production, the outlook for Angola looks bleak over the next few years. Kaombo will stabilize Angola's now plummeting production in the near term, but the nation's hefty base decline rate, and again it's about 13 to 18% annualized, will begin to erode production once again before 2020, so in about a year and a half. According to the International Energy Agency, Angolan oil output will decline once again and break below 1.3 million barrels a day by 2023. That's roughly 1/3 lower than its peak production rate in 2010. Again, as I've explained, there's no way to reverse this decline right now. It's the direct result of the big decline in capital spending on new mega projects over the past few years. Of course, at this point, you might be wondering why I'm focusing so much on Angola. After all, while the country's production decline over the next few years will be dramatic, Angola's 1.38 million barrels of oil exports is kind of a drop in the ocean when you consider the world oil market of around 100 million barrels a day as of the end of this year. However, just consider, because of Angola's high natural base decline rate, I'd expect it to be among the first countries to show symptoms from the CapEx shortfall hangover of the recent oil price collapse. The problem is I'm tracking similar issues from country to country and company to company, and the problem is spreading in one form or another all over the world. In fact, I'm seeing signs the problem is getting worse long before I had expected just a few months ago. I want to show you exactly what I mean and why it has me so worried about the global oil supply outlook over the next 1 to 2 years. Watch your inbox because over the next few days I'll be sending you more of my research on global oil markets. I'll examine more of the growing base of evidence, the proof I'm seeing of the global oil supply shortfall that I believe will send prices significantly higher, to at least $100 a barrel, if not much higher than that, over the next few years. I guarantee you won't want to miss this crucial information. Thank you.